Hey there, everybody. Welcome back to 21st Century Renaissance, another open interest newsletter breakdown on GameStop. I'm your host, Dr. Mike LoPiano. Wonderful to see you all once again. We had an excellent day yesterday. Certainly not something ostensibly exciting on paper, but something that does indeed fit with the model of these volatility cycles that we've been through quite a few times over the past few years, but certainly something that aligns with what we've been seeing toward the bottom of these volatility cycles that have popped up over the past year. So we're going to spend some time going through some of that today. That's looking at some of these indicators that tell me that we are indeed entering into that period. So continuing to develop basically a number of my statements from yesterday's video, from yesterday's write-up. So we'll spend some time talking about that today. And of course, thinking as always about what we're going to look like, what our price action might look like heading into today's trading and into the rest of this week. This last trading week of January, can you believe it? Already the first trading month of 2025 will be in the books, and quarter four of fiscal year 2024 for GameStop will finally be brought to a close. So we'll be thinking about that today. For those of you who may be new to the channel, every day I post analytics from a technical and options perspective on GameStop on my X page. If you're viewing this for the first time, you can find the link to today's article down in the description of this YouTube video. If you are watching this on X, you can find it pinned at the top of the page. Big thanks, of course, today once again to Goat Zubak sponsoring this week's and part of last week's newsletter and analytics. Goat Zubak, thank you so much for your support. Thank you for today's coffee. And to Det Scruffdo. Scruffy, as always, many blessings. Peace to you and your family. Wonderful to have your support as always. Thank you guys, and thank you to everyone who has supported the channel thus far. Thank you for supporting my research. You help me keep all of this non-monetized and free and accessible to everybody. So thank you so much. Really appreciate this. So right today, thinking about how our situation right now may resemble the bottom of these volatility cycles that we are going into. So volatility, right? Those of you who, I mentioned this yesterday, would like a framing, a more detailed framing on the concepts that go into these volatility cycles. I've spoken about them a bit, but really the person I think who's given this the best framing and discussion is Reddit user Gherkinit from a few years back, right? I think he wrote this somewhere around October in 2021. You can find this over on Reddit. It's the name of this particular write-up that he wrote was called When the River Runs Dry. So I really recommend you check that out. Obviously, it was current as of 3.5 years ago, 3 years ago. So there have been some developments since then, but really, basically, the main frameworks that are involved in this particular user's analysis are still valid going into today. So highly recommend you check that out. But okay, so these volatility cycles, right? So basically what obviously Gherkinit is talking about here and what we've been talking about here on the channel, what I've been trying to understand, right? See, I'm not only trying to understand, okay, how do these actually come about, number one, in terms of concept, in terms of structurally how these are framed. I think Gherkinit does a wonderful job, not really in need of refreshing there. But right, how do you actually go ahead and play these volatility cycles in the sense of how do these fit into GameStop's regular price action, and how can you recognize this when you are in the midst of this? What does this actually mean for someone who is trading or invested in GameStop at the experiential level, something like that? So really, I would, I have this right at the top of the article today, and we've really seen three of these. Okay, I would say principally we've seen three major periods of these cycles develop. Okay, the full cycle is, right, GameStop, its price, like let's assume, right, GameStop's price is up. When GameStop's price is up, its volatility is up. And its volatility goes up because its liquidity goes down. There is an inverse relationship between liquidity and volatility in GameStop. Why does liquidity go down when the stock price goes up? Doesn't the stock price going up typically mean that more people are trading it, volume is up? Yes, but liquidity in terms of the ability to settle trades goes down. As we know, right, institutions institutions who aim to manipulate the price of GameStop, who are overexposed to GameStop, who have been exposed to GameStop for many, many years, right? GameStop may in fact be the most heavily shorted stock in history. These multiple failed seller box attempts from years ago, the bags of GameStop may even actually go back to swaps that are bound up with mortgage-backed securities back from 2008. User, it's always sad but truthful, has recently written about that. I'd also highly recommend you go check out his recent due diligence on GameStop swaps going back to 2008. Right. How do you, number one, how do you continue to kind of balance what's going on here? Number two, how do you as an institution, how can you move and manipulate the price such that you can profit off of these recent dynamics in GameStop? And number two is, right, so you're gonna rock volatility and liquidity back and forth. So when the price goes up, right, liquidity is reduced. Liquidity is reduced. It becomes harder to close strategic fail to deliver positions. And so what do? Right? You jack up implied volatility. As dealers, right, as options market makers increase implied volatility, they are then able to sell contracts. They're able to sell, especially short contracts, sell calls. They can go short on options and collect premium, collect credit in order to have a greater cash balance in their accounts, in order to be able to meet margin requirements, and then be able to play around and juggle their positions in order to be able to maintain equilibrium without going bust due to the increased price in GameStop. Okay, so while liquidity is high, you get this cash, you're able to increase these positions, right? You're able to stay balanced. Maybe you roll swaps or something like that, but you're eventually able to get together enough shares. You're able to balance out your positions that then you can deploy short shares, right? You can go ahead and buy. You can close these FTDs. As you close these strategic FTDs, it makes shares available again. You can then take those shares, heavily short those shares, hammer the price down. As you do so, it becomes easier and easier to further close strategic fail to deliver positions on ETFs, and the liquidity will increase. Okay, but then as liquidity has increased, well, then volatility goes down. Well, if you just sold a bunch of options contracts, especially calls, right? If you just sold a bunch of calls, thousands of calls, tens of thousands of calls, hundreds of thousands of calls, and the volatility goes down, those calls are going to get crushed. Both their IV and their delta values are going to get crushed as a result of not only the price going down, but IV levels going down. At this point, you can then prepare to purchase back. You can close these contracts, right? And then wait until your new cycle of FTDs that you just generated from shorting the stock heavily are ready to be closed, right? So you go ahead and you close your contracts. And then as you're closing those contracts, you purchase new ones, right? Now you go ahead and go long on the stock. You purchase these for cheap. And then when you're ready, because you know you're the institution that opened up those fails to deliver, now you can go ahead, close those fails to deliver, send the price back up, and then watch your now long options contracts appreciate tremendously as IV goes back up, right? So, okay, we've seen something like this develop several times, especially over the past year. What my question, right, is not necessarily, okay, right, that's the whole conceptual framework, but what has this looked like over, let's say, the past year? So right here in April, the bottom of one of these periods looks like it went ahead and set in. And this was the type of period that Roaring Kitty in particular used in order to build up his first undisclosed call position. Likely bought something like May or June calls, maybe even May calls in this period, right? So what did we have? Price slowly moving down, volume very low. I mean, we're talking a couple million shares per day, kind of just over 2 million, 2.5 million days and days in a row. And now keep in mind, this is on the lower float. This is on the lower shares outstanding. So the equivalent would probably be in around the mid 3 million range if we were roughly comparing the volume at that time in mid-April to relative if we were to sort of expand it by about 40% since the total shares outstanding outstanding have expanded by about 40% as a result of the at-the-market offerings this year. Right, IV got very, very low, hit 52-week lows. And then all of a sudden, probably not just Roaring Kitty, but Roaring Kitty and others then entered into positions. This was likely the result of back here around earnings, institutions likely entered into strategic fail to delivers, right? They began to short the stock. They entered into strategic FTDs that they did not have to close for another 35 days. Roaring Kitty began to enter into calls, likely back here, released his meme sequence, of course, in this area, and then made those fails to deliver extremely expensive to go ahead and cover. It's very possible that margin calls were a part of this. Maybe an NFCC member went into default. Hard to say exactly what happened, but a lot of this dynamic looks to have been Roaring Kitty strategically being able to essentially volatility squeeze individuals, institutions who were short volatility off of this FTD cycle, off of this volatility cycle, who expected maybe to have generated this movement and then to be able to kind of go back down again, was able to use his options positions by making them public, as well as forecasting his return to Twitter in order to publicize that these events were in fact happening, and then to force a volatility squeeze on these institutions who had short volatility positions. So what we discovered, right? Of course, Roaring Kitty revealed that GameStop's market maker, Wolverine Trading, was naked on a very large portion of their short volatility position. They had not hedged his absolutely massive call position that he had revealed in mid-June in here, right in this area. He revealed that he had purchased 120,000 $20 calls, which were at this point, earlier they had been in the money, but at this point they were not, and revealed that in fact Wolverine Trading was naked most of these calls. They had not hedged these calls as they're obligated to as GameStop's designated market maker. And it's possible that went ahead and maybe caused either they realized they needed to hedge that position, or other institutions realized that Wolverine Trading could be exploited by not hedging that position. And so we went back into the upside. Obviously, right, very exciting period here that played out. Now, what we saw is we've seen this play out actually 2 more times recently afterward. We saw this play out here. Well, it's possible we saw some in this area in late June, early July. Not as detectable, since it was mixed up in all of this stuff that was going on with Roaring Kitty's return and his share purchases and whatnot. But certainly we saw this type of pattern, right? Volume returned to the levels we saw here in mid to late April. IV levels didn't get quite as low, but they got down there. And then basically right around probably about 3 weeks, after this kind of major shorting, there was some distribution in here, but this major shorting sequence, this shorting volatility, selling calls into the Nikkei dip here, mild recovery, but mostly trading flat. IV was low. And then all of a sudden, for these 2 weeks leading up to GameStop's Q2 earnings, IV started to spike back up. Now, this pattern has returned over the past couple of years, as I mentioned yesterday, to GameStop, where the 2 weeks leading up to any earnings period caused this kind of background appreciation in IV. Now, it looked like for the first week of this, once earnings was actually announced on the 27th. So the earnings date, I believe, was announced on the 27th to take place on the 10th. And on the 29th, we got that big up move from institutions likely covering FTDs from back here that they entered into in order to move the stock down during the Nikkei dip. Okay. The following week, right, then we got a post from Roaring Kitty, which also sent us right way back up there. IV spiked, and what did institutions do immediately after that? They entered into another cycle on the announcement that Ryan Cohen would do another 20 million share at the market offering. They used this as an excuse to short the stock, and then several weeks later, this may have been, right, the September 20th stuff was weird. This may have been something correlated in this basket of stocks otherwise. But right, we did have some recovery after that. But then once again, it looked like we entered into another cycle, which saw volume return to this kind of upper 2 million, lower 3 million range. So very similar to what we saw here in late August, very similar to what we saw here in April. And then we kind of just traded flat for about 3 weeks in mid-October, late September, mid-October. And then in late October, we get the same pattern. Small up move on the 25th. That was then moved back down. But then big up moves on the 28th and the 29th when Roaring Kitty went ahead and filed his Chewy 13G. That began this big move to the upside. It's possible that after basically the end of October and through the full month of November, it looks like institutions here immediately after Thanksgiving attempted to generate another volatility cycle by heavily shorting GameStop into the Q3 earnings report. However, as I talked about a couple weeks ago, they failed to do this through the efforts of Roaring Kitty and Ryan Cohen as a 1-2 punch, first on December 5th, and then on December 10th, first through Roaring Kitty either maybe purchasing something in the background or simply from the fact that he did indeed post this time you cover post on the 5th. Not sure what exactly it was that caused this type of reaction in the market. But then, of course, the second punch was Ryan Cohen on the 10th, not only having a better than expected earnings report for GameStop, but then going ahead and choosing not to do another at the market offering. Maybe the purpose of this 20 million share offering at the Q2 earnings report was something of a little bait and switch to kind of, lure shorts, lure these institutions generating these cycles into thinking there was something of a beef maybe between Roaring Kitty and Ryan Cohen, only for Ryan Cohen to say, no, we're not going to do that. Gotcha. Something like that. I won't speculate too heavily. But then we got this kind of extension of this, and only through pushing the price higher were institutions then able to go ahead and likely close out these positions, right? As I mentioned back on the 13th, GameStop was right on the tail end of a liquidity crunch, right? Shores available to borrow got down to 100,000, right? We're used to seeing GameStop when the price is up, right? We see these numbers, return, right? All throughout this period, the number of available shares was something in the upper 2 millions, lower 3 million range. And then those shares were then used to short, but then it seemed like they couldn't go ahead and replenish until somehow in here, these around the 10th, around the 13th, 14th of January, especially on the 14th, right? About 1 million shares became available to borrow per Interactive Brokers on the 14th of January, during the 13th and on the 14th, so much so that yes, institutions could go ahead, short the stock heavily, which they did on the 14th and 15th, and move us into this beginning of this new pattern. Now, yesterday, a very interesting day because our total volume and now our IV, as I've talked about, is approaching 52-week lows. It's not quite as low as it was back here. We'll see this graph in a second. Not quite as low as it was back here. It is looking like we are hanging out, especially midday around mid to late August levels. And in terms of daily volume, we have dipped down into the lowest of the low daily volume, of course, relative to the amount of shares outstanding that we saw in mid-October, in mid to late August, and in mid to late April. So we are getting around there. Now, those volume numbers, we saw those get logged for a few weeks before we had the consequent up move, right? It wasn't like, oh, 1 day of 3 million volume, 1 day of 2.5 million volume, tomorrow we're going to explode, right? No, it was multiple days. It was generally about 2 weeks of seeing that type of volume in the 2.5 to 3.5 million range, maybe kind of peaking maximally around 5, when in general our average volume, let's say in this period, is between 8.5 and 11 million. We are starting to see those numbers. So again, right, that's another data point that I'm looking at that's saying, right, my remarks yesterday, that we're entering into maybe this 2 to 3 week period of kind of consolidation and moving sideways, that this is starting to look, the volume data we're seeing in addition now to the IV data, and as I'll point out, as we're going to see in our technicals as well, is starting to look again like what we saw these flat trading periods, these low volume and low volatility periods, these sideways range bound consolidations, it looks like we are logging. We are even more resembling this type of pattern. Doesn't mean, again, I'm not going to say, right, it doesn't necessarily mean that, something big has to happen, but we're seeing the data that looks like that pattern. Every day we get more of this is another data point, is another feather in the cap, is another line in favor of the argument that says, yes, we have indeed entered another volatility cycle, and we are proceeding on schedule for such a full cycle to play itself out within the next couple weeks. So probably somewhere around mid-February when institutions are going to go ahead and start filing, as I indicated yesterday. So, right, what are we looking at in terms of our day-to-day price action? What do we see going on here? Yesterday, we largely got what I spoke about, what I anticipated we'd be seeing here in SPY in the S&P, right? Little flirt down just below our kind of call wall support, or not call wall, I should say, but right down the gamma flip line, but not low enough to kind of trigger one of those bigger volatility positions at 595. Return to the upside, moved over 599. That's call gamma. That is trader, long call, dealer, short call gamma conditions, which lends itself to more stable trading, slower upgrind, less volatility, right? As price moves up in SPY, volatility goes down, which means, right, as the price moves up in SPY, liquidity increases, so you have lower volatility, so you have swings aren't quite as big, you get stable trading, and you kind of have a grindy up move with the call wall as an intra-week and midweek target right now, sitting up there in the 610 area. 6,100 over on SPX. Okay, so that's what we are looking at. And right now, pre-market, we're hanging out in that area. I will point out that things are a little bit more ambiguous. Things are a little bit more, I should say, ambivalent with respect to this range. We still have above us right now, kind of just above us, kind of 604, 605 and up. We're looking at that same type of stable, grindy up move there. But now our put level, the area where we have a little bit more volatility settling in, is moved up. So our gamma flip line sitting at around 604, 603, and we have 600 or 6,000 SPX is standing out as something of a more volatile level, right? So if we see our price move down through these levels, volatility is going to spike as the price does so, and we'll see a kind of quicker rundown as those levels are approached. We have some dead zones between them, right? Things kind of neutralized, but basically below us, if we get, say, something bad from Powell today, I don't think we see anything right now. Starting to move down a little bit pre-market. Don't see too much. No news yet on that respect, but something to keep in mind, something to keep an eye on. If we do really kind of definitively move down there, we can trigger those levels. What I would say is, even though if we look at SPY and we look at SPY's gamma exposure right now, it might not look awesome. Certainly, right, we can see how much more traders have built up puts far closer to where our price is right now. That might be subject to change. But if we go over on SPX, certainly these are my comments toward the end of last week on Friday, which basically made me think, I think going into this week we're looking pretty stable. We still have that optimism in SPX out toward the middle of February. Right now it's February OPEX. So basically what this is saying is, in general, traders are basically pretty stable. Traders are mostly betting on calls. Traders are mostly long calls, mostly long the market, and are optimistic heading out the next few weeks. Is that guaranteed? No, of course, news can come in and disrupt this. But certainly right now, that in that kind of medium term, a few weeks out, that's what we're looking at. What does that mean for GameStop? That means, well, lesser opportunities, fewer opportunities for heavy shorting, kind of interventive shorting, despite the fact that we do have a lot of shares outstanding now. They're popping back up to 2.1 million. Price movement recap, as flat gets, man. I mean, right. So again, we did a good job yesterday calling out that 2650 was deceptively put favored, right, in terms of put gamma. So when we look at our data, when we look at our gamma exposure data, right, it doesn't differentiate the side of the trade that the trader or the dealer is on when you're looking at that raw data. It makes an assumption that traders are often, this is true most of the time, that traders are long puts and traders are long calls. It's especially true if you're looking over at SPY. 75% of all daily options volume on the S&P 500 is 0 DTE single leg options, either puts or calls on behalf of retail. So that's how retail trades. So generally when you're looking at that data over on SPY, that's a fine assumption to make. That's usually true. However, you move over to equities, you move over to something like GameStop, that's not necessarily the case. And that increasingly becomes not the case at kind of weird strikes, at uncommon strikes. So 2650, I pointed out yesterday, got this, right, this bump up in about 3,000 calls. A trader at open yesterday, or I should say the day before, 2 days ago, on Monday's trading, opened 3,000 short puts at 2650. Uncommon strike. That was 75%. No, that was more than 75% of the volume. That was 75% at the end of the day of the open interest at that strike. That was something that was over 90% of the volume at that strike on that particular day. So, right, when traders are short puts, that's not common, right? That's not the standard assumption when looking at gamma exposure data. So that 2650 shows up in the gamma exposure charts as being, ooh, heavy puts. We have risk of running to the downside, right? And of course, if you're just looking at that expansion in puts and you're making that assumption, that's what that's going to tell you. But because we were able to see, thanks to, of course, unusual whales being able to track the side of the trade that this came on, we were able to see that those were sold at the bid. That trader was short those puts, which meant that the dealer was long those puts, which meant that the dealer had negative gamma from those puts, negative gamma and negative delta on their books because they were long those puts. What that meant is as the price approached that level intraday, it acted as a support since dealers had to buy shares to hedge their gamma and delta exposure as that strike was approached. What that meant is as the price approached that strike and dealers were buying, that buying pressure, that support from underneath peaked as the strike was approached intraday. So gamma values peak as the strike, as an options contract is about to go in the money or about to go out of the money. So when it was approached from above, it acted as a support rather than as a put would typically act, right? So when dealers are negative gamma, when they have negative gamma on their books, that there is an antipathetic relationship between how the price moves toward a strike and how dealers act with respect to it. So if dealers have negative gamma on their books as a strike is approached, they're buying shares. Okay, they're buying as it's approached from above. They're selling as it's approached from below. Okay, so the price is going up, they're selling. The price is going down toward it, they're buying. It's the opposite for puts, right? With what is the default assumption for put gamma, what is positive gamma on their books. Positive gamma, as a strike is approached, they're buying. As a strike is moved away from, they're selling. So if 2650 were the assumption in the other direction, if the dealers were positive gamma because of those puts, as if they were short those puts, as that strike would be approached, they would be selling more, right? They would be selling more rather than buying. That's not what we saw though. And indeed, because of this during the day, 2650, we didn't even really get down there, but it functioned as a support intraday. So very good. And then very late in the day, as I mentioned, right? I mean, there's not a lot of space to the downside. Based on our recent volume, it would take some more aggressive shorting to move through that support. And that would be something that would be risky, right? You don't have a lot of buyers down below that 2650 level. So we didn't see any attempts to really take that risk and push that down there, largely because it would be resisted on the way down there, and it would be a path of more resistance, right? So typically when you have days like this, if you're an institution, right, and you kind of met your objectives, you had to push the price below a certain level, you had to cover FTDs. What this portion of the cycle suggests to us is that the previous cycle, right, those FTDs are cleared. There isn't anything else from that cycle now that's being can kicked. New FTDs on ETFs have been strategically put in place as a result of this down move, right? So what just happened, say early, or I guess 2 weeks ago now, right? New FTDs were entered in there, and we're in the middle of this new FTD cycle. But there isn't really a reason to push the price down at this level, since you're already in a decent position, I guess. If you need to cover, you can cover now, but you're also, right, you don't necessarily want to put it down. What you really want is you want to grind IV as low as possible. Yes, okay, usually when the price moves down, that occurs, but you get that IV depletion effect regardless of whether you're pushing the price down. Now, if you push it down, you also run the risk that somebody's going to see the price at a lower level and go, ooh, $25, I'm buying, right? Some institution might come in, buy up 1 million shares or something, and then squeeze you out of your short position at a time when you would really like not to do that. So if your primary objective now is just kind of to grind IV down so you can take advantage of the up move whenever you're ready to close those FTDs kind of later in the cycle, you don't really need to push it down. You can. I mean, and we've talked about this too. There was also this potential of, well, maybe there's a swap that needs to get rolled, something like that. Seemed like if it was rolled, if there were yesterday or the day before something to be rolled, it looks like, it could have happened in these mid 26s, which is the lowest we've seen basically since early December 5th. This is the lowest price we saw there. So didn't really look like, maybe that happened, but didn't look like there was any real need for some sort of external element like that in order to continue to force down the price. So what did that mean? It meant that if you're trading options, you're kind of just stimulating activity throughout the day. Well, it means that, path of least resistance is just to bump stuff back to the upside. And that's what we saw with this move here later in the day. A couple 100,000 shares, right? Little move in the options market and boop, right? Up 50 cents. Options contracts, especially short dated stuff, really appreciated quickly because now you're thinking, right, okay, IV's been flat for a while. Especially the past 2 days. Like, man, IV really, especially on the short dated stuff, like those lost a lot of value because of how low our IV has been. Right. So, you see levels like this. I don't know exactly how Schwab comes up with these percentages. You've got IV 30, you've got mean 10-day that I look at to get different views of this. But obviously, right, each contract has its own IV value based on where the price is, based on what the expiry is. So you'll see this, right, and these get modified. But these contracts have really lost a lot of value due to the conditions that we saw over the past couple of days. So those picked up some serious value, and then we move sideways into the close. Now, okay, what does that move? What does that mean now? As far as today's trading, we've still got liquidity is pretty high in terms of short stuff. Right now, we're back up to 2.1 million. Always important to keep that in mind. If there is a swap that needs to be rolled, these can always be deployed to short the stock. It's always important never to lose sight of that. They can go ahead and use these to short the stock. Institutions can do this if they need to. So whenever you're thinking about making trades, right, this is not necessarily trade advice, this is not financial advice, but important to keep in mind that they can do this. Now, there may be lower or higher probabilities about when they will do this, right, when they could decide to do this. We're looking at some of the lowest probability conditions for a heavy deployment of short volume, right, assuming there's no swap thing going on right now, for them to deploy this kind of targeted short volume right now. And I would say the peak danger zones for this have kind of passed. Now, there could be something else, of course, that I'm not aware of. There could be some other swap or whatever in there. But basically, with these kind of stable conditions in the market, as long as this continues over the next few weeks, as long as IV kind of continues to trickle and we're kind of sitting down here at the bottom of this cycle, kind of consolidating, I would say these are low risk conditions for that type of thing to emerge. But it can emerge, so it's always important to factor that into decision making if you're making trades or deciding to invest or open a new position or something like that, right? Always important to keep that in mind. There's always that risk, no matter what the conditions are. That always has to be some part of. It's always important to be aware of that as some part of your risk assessment and calculation. Technicals wise, right, still looking at, if we kind of zoom out a bit here, right, moving into this range bound formation, staying pretty tight here. Our macro bearish regression channel flattening out, kind of just looks like listing kind of forward, right? We're going to get some kind of whoop-de-doop here, something looking like what we saw in kind of October, just kind of just kind of playing around in this area. That's again, right? That's what our options data is also telling us for right now. If we look at, if we continue to look forward at our max pain data, right? So it moved down a little bit this week to 27. But, basically now out through February OPEX, it's just like, it's $27 like every week. It's 27 for this week, 27 for next week, 27 for the next week. It's just $27 every week. All right, it's 27 for this week, but it's right. It's $27 every week now. So options data certainly telling us flat. What we see here, right? We see actually this was very interesting. This was a contraction of long puts at 25. So trader long puts came off the board, a higher number it looked like than this, but probably we saw some trader short puts come on the board at the same time that trader long puts came off the board. So this position again, 25 is going to be deceptively supportive. 2650 still deceptively supportive. This area is sort of skewed toward trader short puts, and it does look like we have traders also taking long puts off the board. So this is saying, okay, downside, traders are making this assessment. Okay, deeper downside in the short term, not really feeling the risk there. It doesn't look like there's much for me to capture. Kind of these moves down yesterday, day before to the 2650 range. They're kind of like, that's it. We're probably tapped out there. Mix slightly skewed towards bearish calls, so short calls here. How's that going to factor into our landscape trading wise? Probably going to be a little bit less resistance than we might expect immediately above us. Again, right, so if our trading volume stays low like what we've seen, we're hanging out probably right here in the 2650, 2750 zone. Why did we stop at 2750 yesterday? Well, because that low volume wasn't enough to push us through this call gamma zone. So these are trader long calls. These are dealer short calls. There's a bit of hedging resistance as that price level is approached. And we just didn't have anything yesterday that would suggest, that would overcome that type of hedging resistance, right? And it's not just at this strike. There's also hedging resistance from here as it's stacked on top of each other. In order to get that kind of gamma ramp effect where you kind of shoot up through these levels, you need to have the right flow of, usually it's options volume, but you need to have the right flow of volume coming in. It has to be the right rate of volume and the right amount in order for sort of new hedging pressure from contracts being purchased to overcome some of the existing hedging, and then have hedging at out of the money stuff also kind of pick up, right? Because those values get low when you have the kind of the options environment, it collapses. Things get very, very tight. Dealers are de-hedging themselves for a lot of the out of the money stuff because of charm, because of low IV. So Vanna goes down as IV goes down, right? So delta goes down, especially for these out of the money contracts as IV goes down. The more out of the money your contract is, the more important IV is going to be in order to determine the pricing. So most of that value is going to be tied up. Most of the delta value of the contract is going to be tied up with implied volatility. So as you'll see IV spike, a lot of these, right, part of what will fuel something like, right, so when you see like a gamma ramp thing, it's like, it's not just gamma that's doing that. In part it is gamma, but there'll also be some like a Vanna component, right? So as IV is making delta appreciate, and then like the Vanna component influences the gamma component because, the gamma will go up based on the rate of change of Vanna, right? So then there's also Volga, which again is a fake Greek letter, also called Vama, which is meant to be like the gamma of volatility, right? So it's the rate of change of Vega, which is the IV component. The Volga can affect the Vanna, can affect the gamma because it's tied up with the delta. And so anyway, these factors combine in such a way that this this high cluster of OI kind of like out of the money, that even though it's not necessarily going to go in the money, it can drum up a lot of hedging pressure in the event that you get the right flow of options volume, a bullish options volume down here, enough that it can really carry you up into this $30 call wall. So it's a little early for that. The later we get in the week, the more profound that like Vanna, Volga element is going to be for these out of the money contracts. Right. So you want basically IV, you want Charm to basically take a lot of delta out of this. Charm's going to be more like, there'll be more profound changes for Charm stuff with respect to the stuff that's kind of lower, but you get big percentage changes up here, depending on how early in the day that happens, on Friday or Thursday or something like that. But, you could start to see some recovery if they say, okay, we just kind of ground down here. We want to drum up some more interest. These guys, they have in their mind, all right, we're not sending this really far back the other way until mid-February. We're not going to do that until then. But that's 3 weeks, right? We want some value now in these. We want to sell more contracts. Drum up IV just a little bit, right? Even last week's like 13 percentage point increase on Thursday, hugely appreciate, right? You had like, what was it? The 30s, like the February OPEX 30s, just on Thursday's moves last week went from being like $1.40 or like around $1.40 on average to in the middle of the day, they were like $2.10, $2.15 on average. That's a huge, right? That's a huge appreciation in those that then you can sell. And I think yesterday they got down to like 90 cents. So, right, you can walk those kind of up and down, even with these small movements in the price. It doesn't look like much, right? Especially if you're a buy and hold investor. Which, by all means, great, right? You don't have to worry about this stuff, but you may look at this and go like, why do these moves matter? Like, why do they go through all the effort to make these moves happen? And it's part of it is that there's profound changes in the pricing of these derivatives based on these very small movements intraday when they occur at the right times, right? In the right context of price action. So we could see something like that. If we don't see volume, we're hanging out here. If we do, it's probably going to be bullish volume, and it can take us up into this range. I don't think it would extend much beyond 29, largely because then as it settles, it can then get trapped in this 28 to 29 region. We have two big call gamma positions here, two call X positions. It'll trap the price. And then if that happens sometime today, or even kind of early on Thursday, that's enough time to kind of let things kind of stabilize there. And then we can see like what we saw last week to a certain extent, where then Charm can set in. Nobody's trading it anymore. Everybody's got their short calls positioned, and then it just kind of down to the downside. We move back into the sub 28. Everything here goes out of the money, and then dealers are happy because they're getting their max pain at around the 27.50, whatever that is. So that's what we're looking at there. Like I said, I don't think we're looking at a huge move back to the upside just yet. I'm personally not anticipating anything like that until the middle of February, when this volatility cycle really has come to its full fruition, like we saw in October, like we saw in August, like we saw last April. It really took I know it can be exciting. I certainly get excited when I start to see those values, when I start to see that low volume, when I start to see that, ooh, this is getting really close. This IV is getting really close to these 52-week lows. But in all three of these periods, it took that full 2 to 3 weeks really of trading at those levels until things had really came full circle and it was ready to drum the price back up and move volatility back to the upside. So that's what I'm looking at here, basically reiterating my comments. We just see, here's our trend. Continue to slowly list down, probably a little bit more room there to the downside. Doesn't mean we can't get some play back to the upside here. So yeah, that's, hopefully you guys found that. I keep doing this. Hopefully you guys found that informative. Hopefully that was helpful, right? It's my mission, of course, to help keep my fellow investors in GameStop abreast of how this dynamic works. Additionally, I'm trying to understand how this works for myself so I can make better decisions. Like I said, this is not financial advice, not trade advice, but it seems, that this is a real thing that goes on with GameStop. These are the real dynamics of what moves our price action on the day-to-day, week-to-week, month-to-month level. That this is really what we look at. If you trade GameStop, if you are invested in GameStop, these are the dynamics that are going to confront you as a trader and an investor on a regular basis, in defiance of things that you see on other stocks, right? You can look at a number of other tickers, many other tickers, where you can just do TA and TA works and it's great. There's a reason why, say, just kind of TA people basically always fail in longer periods of time. Now, it's not that TA is useful or useless. Technical analysis can be very useful in GameStop, but you can't ignore, I would say personally, my results over the past year, just about a year of trying to really get this down, trying to really make the most sense out of this. And 9 months, let's be a bit more honest, but not 9 months. Trying to make the most sense out of how this is working at this kind of detailed level. It's that if you put too much confidence in just kind of TA all the time, it works within the context of individual volatility cycles. But it does not whenever those volatility cycles come to an end, right? It then can kind of fall apart, especially at some of those local, those closer resolution levels. It kind of stays valid out at that weekly level, possibly even monthly. I haven't spent too much time looking at the monthly charts. It stays, it can stay valid out at that level, but you'll see, as we saw, right, just a couple weeks ago, the day-to-day, week-to-week paradigms, technical paradigms, have a tendency to fall apart whenever another one of these volatility cycles begins with this kind of heavy shorting. So something to keep in mind, right? I'm always trying to improve how I understand things, always trying to challenge my own interpretations of what's going on. So I hope this is useful to you. I hope, certainly if you have any questions, if you have any pointers, want to poke holes in anything I'm saying, certainly please go ahead and do so down in the comments. Deeply appreciate, again, all your support. Thank you, everyone who supported thus far. And let's go GameStop. We'll see you tomorrow. And cheers and good luck out there.